Imagine you're the CEO of a major telecom company.
Okay, that's a stressful start.
Right. But just picture it. You are sitting in this massive boardroom, and you're staring at a proposal to lay thousands of miles of brand new, like, state-of-the-art fiber optic cable across the entire ocean floor.
Oh, wow. That is a massive undertaking.
Exactly.
Ye-
The cost is just astronomical. I mean, we're talking billions of dollars here. And if you say yes to this, ships leave port, trenches literally get dug at the bottom of the Atlantic Ocean, and those billions are just gone.
Yeah, that they're transformed into glass and plastic.
Right, sitting in the freezing dark. And now think about this. If 5 years later, satellite internet suddenly just makes your underwater cables totally obsolete, you can't exactly, reel that cable back up.
No, definitely not.
You can't return it to the manufacturer and ask for a refund. The money is spent. The concrete, so to speak, is poured.
And that, right there, that is the terror. And frankly, the thrill of corporate finance. You are making decisions today in a world of profound, unavoidable uncertainty that will basically chain your company to a specific destiny for the next 10, 20, maybe 30 years.
It's a one-way door.
Exactly. It is a one-way door. Once you walk through it, the stakes are completely existential.
Which brings us directly to you, the ambitious MBA student who is listening to us right now.
We know why you're here.
Yeah, we know you are staring down the barrel of some major upcoming corporate finance exams. And we know that just hearing the phrase capital budgeting might be triggering like a mild fight or flight response right now.
Because your notes are probably just a dense thicket of formulas, right?
Yeah, a sea of acronyms, NPV, IRR, API, those awful, complex tax depreciation tables. It feels like this abstract, detached math. But as we just established with the ocean cable, it's anything but abstract. It is literally the language of corporate survival.
It's the ultimate filtering mechanism. I mean, capital budgeting is how a company separates the brilliant strategic pivots from the catastrophic company-ending money pits.
Right.
And to actually pass your exam and, honestly, more importantly, to succeed in a real corporate boardroom, you can't just memorize the formulas. You have to truly understand the financial philosophy behind them.
Okay, let's unpack this. We are going to transform those dense notes on the capital budgeting decision into a conceptual framework that actually finally makes sense. We are doing a deep dive today.
A very deep dive. We're going to cover everything.
We really are. The mission is to build an audio study guide, an audio memory palace for you. We're going to walk through the entire life cycle of a massive corporate investment.
Starting with the fundamental philosophy, right?
Yes, exactly. Why these decisions are so terrifyingly risky. Then we'll navigate the single biggest trap that examiners love to use to fail students.
Oh, the illusion of accounting income versus cash flows.
A classic. The absolute classic. From there, we will construct a bulletproof project timeline, step by step, showing you how to handle the really murky tax labyrinth of replacing old assets.
Which is where so many points are lost on exams.
So many points. And finally, we'll break down the actual decision-making metrics, from the flawed, older, non-discounting methods to the modern gold standard of discounted cash flow.
Because by the time we finish this discussion, you won't just be looking at arbitrary equations. You're going to be looking at a toolkit for literally predicting the future.
So let's start with that foundational philosophy, because before a spreadsheet is ever even opened, we need to understand what capital budgeting actually is, right?
Yeah, the academic definition usually calls it investment appraisal.
Right. It's the planning process used to determine whether an organization's long-term investments are actually worth pursuing.
So we aren't talking about trivial things here.
No, we're talking about acquiring entire new factories or, funding a 10-year pharmaceutical research program or aggressively expanding into a totally emerging international market.
And the defining characteristic there, the thread connecting all of those, is the time horizon.
The long game.
Right. Buying printer paper for the office or paying this month's electricity bill, that's just an operational expense. The benefit of that spend is consumed almost immediately.
Right. Paper is used, the lights stay on.
Exactly. But capital budgeting deals with expenditures that yield benefits spread out over a long, long series of years. You are intentionally starving the company of cash today.
Putting the company on a diet, essentially.
Yeah, exactly, in the hope of creating a much larger feast tomorrow. And the ultimate goal, the absolute North Star of this entire process that you must write down, is maximizing shareholder wealth.
Right, because if you're a publicly traded company, you are essentially gambling with other people's retirement accounts.
That's a great way to put it.
If management takes those funds and allocates billions to a project that ultimately returns, like, less than what the investors could have made just putting their money in a basic, boring index fund.
Then management has actively destroyed value,
Right. They haven't just failed, they have made the world poorer.
which is exactly why the process has to be so rigorous. Corporate finance theory outlines several core pillars that make capital budgeting completely indispensable.
Let's run through those pillars, because these make for great essay answers.
Absolutely. It really begins with strategic alignment. A company can't just randomly fund projects because they sound, fun or exciting.
Let's build a spaceship.
Right, unless you're an aerospace company, that's a bad idea.
Yeah.
Capital budgeting forces a business to explicitly formulate long-term strategic goals and then ruthlessly measure every single pitch against those specific goals.
So it creates this structured environment for hunting for new ideas.
Exactly. That's actually the second pillar. Having this framework forces a company to actively seek out new investment opportunities.
Because if you know exactly how to measure a good idea, your managers are actually incentivized to go find them out in the wild.
Whether that's a new proprietary technology or maybe an untapped demographic, it turns a static, comfortable company into a really aggressive, competitive organism.
And it forces a collision with reality, doesn't it? I mean, we all know that executives love to dream big.
Oh, absolutely. A visionary CEO can paint a beautiful, inspiring picture of a totally new product line.
But capital budgeting acts as the great sobering agent. It requires estimating and forecasting actual, concrete future cash flows.
You have to take that beautiful, abstract vision and attach cold, hard, often very ugly numbers to it.
Like, what will the raw materials actually cost in year 4?
Right. Or what is the projected tax rate going to be in year 7? It completely strips away the marketing spin.
I think one of the most underappreciated aspects of this, and listener, this is something that makes for a brilliant, nuanced answer on an exam, is how capital budgeting acts as a communication protocol.
Oh, yes. The information transfer.
Yeah. Imagine a multinational corporation with, say, 100,000 employees. You have this engineer working in a semiconductor plant in Taiwan, and she realizes a specific new robotic arm could increase the daily yield by 4%.
Which is massive at scale.
Huge. But how does that incredibly niche, localized, technical idea make its way to a board of directors sitting in a skyscraper in New York who have to actually approve the $50 million purchase order?
That's the filter-up process.
Yeah.
And it really is a beautiful piece of corporate machinery when it works.
Because the board in New York doesn't know anything about semiconductor yields, right?
Right. Capital budgeting creates a standardized language. That engineer in Taiwan doesn't just send an enthusiastic, highly technical email. She works with her local finance teams to build a standardized capital budgeting proposal.
Okay, so she translates it.
Exactly. The proposal includes the required initial outlay, the projected cash savings from the increased yield, and the estimated lifespan of the robotic arm.
And then that standardized proposal can be objectively compared against something completely different, right?
Yeah. Yes. It can be compared against a totally different proposal from, say, a marketing team in London asking for $50 million to launch a brand new advertising campaign.
It's an apples-to-apples translation device. The board in New York doesn't need to understand the underlying robotics or the nuances of the London ad market. They just look at the capital budgeting metrics, the return profile, and allocate the limited resources to the highest yielding project.
Furthermore, once the concrete is poured, as you said earlier, and the money is allocated, the capital budgeting framework provides the baseline for monitoring and control.
You don't just write the giant check and walk away.
Never. You have a detailed year-by-year forecast of what the expenditures should be. So if the project starts bleeding cash and wildly overrunning its budget in year 2,
the framework acts as an early warning system. Management can step in, audit the whole process, and potentially kill the project before it takes the entire company down. Okay, so if I'm a student sitting for my MBA exam, and the professor asks me to categorize the types of projects this framework is used for, how should I logically group them in my mind?
they'll definitely ask that.
Because building a massive new factory feels fundamentally different than just, upgrading an aging piece of payroll software.
They are very different, and your examiners will fully expect you to recognize those distinctions. Generally, you can bucket them into 3 major categories.
Okay, let's hear them.
The first is expansion into new products or new markets. This is the sexy, high-growth stuff.
The stuff that makes the news.
Right. Imagine a legacy energy company that deals only in oil and gas suddenly deciding to build an enormous multi-billion-dollar offshore wind farm division.
That's a huge pivot.
It's a completely new technology. It involves a new regulatory environment and entirely new revenue streams. The risk here is absolutely monumental because the company has zero historical data to rely on.
They are guessing. Educated guessing, but still guessing. What's the second category?
The second category is a bit safer. Expansion of existing products or markets.
Okay, scaling what works.
Exactly. Say you're already making a highly successful electric vehicle in North America, and you realize demand is really spiking in Europe. You use capital budgeting to justify building an identical manufacturing plant in Germany.
So you know the product works, you know the manufacturing process.
Right, you're just scaling up. The variables are much easier to predict, so the risk is lower.
And the third category?
The third is the most common, yet deceptively complex, replacement decisions. And this actually comes in two distinct flavors.
Okay, what's flavor one?
There's the routine replacement. A delivery truck breaks down. You buy a new delivery truck to maintain your current operations. The revenue doesn't really change. You're just preventing a total halt to the business.
Just keeping the lights on.
Right. But the second flavor of replacement is strategic modernization.
Ah, okay. How is that different?
Well, you aren't just replacing a broken delivery truck with the exact same gas-guzzling model. You are proposing replacing an entire fleet of gas-powered trucks with a brand new autonomous electric fleet.
Oh, wow. So the initial cost there is staggering.
Staggering. But the proposal argues that the massive reduction in fuel costs and labor costs over the next decade will more than pay for the vehicles.
So you aren't necessarily increasing your top-line sales at all, but you are radically altering your cost structure.
Exactly. And that distinction is a classic exam scenario. They will absolutely ask you to evaluate a modernization project where the primary benefit isn't new revenue, but rather a dramatic reduction in operational cash outflows.
You have to be able to conceptually model those cost savings as the actual return on the investment.
Precisely.
All right, I want to pivot here just a bit because we keep talking about how risky these decisions are. But let's really drill into why an examiner considers capital budgeting the most dangerous area of corporate finance.
It is the most dangerous.
We talked about the pouring of the concrete, that irreversibility, but there has to be more to it than just the fact that it's hard to undo.
Well, the irreversibility is the cornerstone of the risk, sure, but it is compounded by the sheer scale of the funds.
The size of the bet.
Right. We are talking about financial commitments that can represent a massive percentage of a company's total market capitalization.
If a new product launch fails, like a new flavor of soda, what happens? You fire the ad agency and write off a few $1 million. Right?
Yeah, it's a blip. But if a multi-billion-dollar semiconductor fabrication plant is built to manufacture a chip architecture that the market suddenly rejects, that company might literally face bankruptcy.
Because that massive amount of capital is trapped. You cannot easily liquidate a highly specialized fabrication plant. It is a sunk cost. No one else wants it if the tech is dead.
Exactly. And the final element of risk is the time horizon itself. The further out you try to forecast, the wider the cone of uncertainty becomes.
Predicting what a consumer wants tomorrow is hard enough.
Right. But capital budgeting often requires predicting inflation rates, tax policies, and technological shifts 10 or 15 years into the future. It is an exercise in managed hubris.
Managed hubris, I love that. Which is actually a perfect segue into the numbers we actually use to try and manage that hubris. Yes, the math. We've established the philosophy. We know what a project is. Now, listener, we arrive at the threshold of the most brutal trap in all of corporate finance education.
If there's one thing you take away from this entire discussion today,
let it be what we are about to cover right now.
The trap is the widespread confusion between accounting income, which is often referred to as net income or profit after tax, and actual liquid cash flow.
If an exam question gives you a beautifully formatted income statement for a proposed project, complete with this shining net income figure right at the bottom, and the question asks you to evaluate the project based on that number,
it is a siren song.
It's a total trap. If you plug net income into your valuation formulas, you will fail the question, period.
To understand why, you have to understand the fundamental difference in what accountants care about versus what finance professionals care about.
Okay, let's break that down. What do accountants care about?
Accounting income relies on the accrual method. The primary goal of accrual accounting is to measure periodic performance. It wants to give investors a smoothed-out, matching picture of what economic activity occurred in a given year.
Okay, let's illustrate this with an example so it sticks. Imagine our company sells $10 million worth of heavy machinery to a client in December.
Okay, good scenario.
We deliver the machines, the client signs the contract, everyone's happy. But the contract says they don't have to actually pay us the cash for 90 days. It's a net 90 term.
Right. Now, under accrual accounting, the moment that contract is signed and the goods are delivered, you record $10 million in revenue. Your net income for the year shoots straight up.
So on paper, my company looks incredibly profitable. Wall Street is thrilled. The stock price
Let's
jumps.
check the bank account.
It's totally empty.
Exactly.
Yeah.
You cannot pay your workers Christmas bonuses with an accounts receivable ledger.
You cannot pay your suppliers with net income. You pay them with cash. And the cash hasn't arrived yet.
What's fascinating here is that this works both ways. That is the revenue side of the illusion. But the expense side is where examiners really love to hide the tripwires, specifically with non-cash expenses,
Like depreciation.
especially depreciation.
Let's dive really deep into depreciation, because honestly, when I first encountered this concept, I found it totally counterintuitive. Why do accountants literally invent a phantom expense?
It comes back to that matching principle we just mentioned. Suppose you buy a piece of manufacturing equipment for $1 million, and it will last for 10 years.
Okay, $1 million out the door on day one.
Right. If you record that entire $1 million cash outflow as a single expense in year one, your company will look like it suffered a massive catastrophic loss that year.
Investors would panic.
They would. And then for the next 9 years, because you have no major equipment expenses on the books, the company will look artificially hyper-profitable.
That volatility would terrify the market. It doesn't reflect the reality that the machine is just slowly being used up over a decade to generate that revenue.
Precisely. So the accountants step in and say, let's spread that cost out. They mandate that you take a depreciation expense, say $100,000 a year for 10 years.
Okay.
Every single year, you subtract $100,000 from your revenue before you arrive at your net income. It smooths out the profitability. It creates a stable, predictable narrative for the stock market and, crucially, for tax purposes.
But, and listener, this is the absolute crux of the matter. You are not writing a check for $100,000 to a mystical entity called depreciation every year.
No. No actual cash leaves the building in years 2 through 10.
The cash left the building on day one when you actually bought the machine.
Therefore, if you use net income to evaluate a capital project, you are actively deducting an expense that doesn't actually exist in terms of real liquidity. You are artificially lowering the true cash-generating power of the project in your mathematical analysis.
Because finance, unlike accounting, is totally obsessed with liquidity.
Capital projects are so massive that if you run out of actual cash, even if you are technically profitable on an accrual basis, the game is over. The company dies.
So we're stuck with this flawed, smoothed-out net income number on the exam. How do we fix it? How do we perform CPR on it and resuscitate it back into a living, breathing cash flow number that we can actually use for our valuation formulas?
You have to systematically reverse the accountant's illusions.
Step by step.
Yes. You start with the net income. First, you look for any non-cash expenses that were subtracted, and you add them back.
So the most vital one, universally, is adding back that depreciation.
Yes. You also add back any amortization of intangible assets. If the accountant subtracted a non-cash capital loss from the sale of an old asset, you add that back too.
But it doesn't stop with just the expenses, does it? You also have to adjust for working capital.
Oh, working capital, yes.
Yeah.
The day-to-day liquidity tied up in the business. And this requires some real mental gymnastics for a lot of students.
It definitely does. Let's look at accounts receivable again, the money customers owe you. If your accounts receivable balance increases from one year to the next, what does that actually mean?
It means you recorded revenue that you haven't collected cash for yet. To find your true cash flow, you have to subtract that increase from your net income.
Because you haven't got the money, it's an IOU.
Exactly. Conversely, if your accounts receivable decreases, it means clients finally paid their old bills. Cash came in that wasn't necessarily tied to this year's newly recorded revenue.
So you add that decrease to your cash flow.
Right. And the exact same logic applies to inventory. If you spent cash to build up a massive stockpile of raw materials in the warehouse, your inventory increased.
That cash is gone. It's locked up in physical goods sitting on shelves.
So an increase in inventory is a subtraction from your cash flow.
It's a meticulous process of reconciliation. Net income is a theory. Cash flow is a fact. Listener, write that down, underline it twice. You cannot proceed with capital budgeting until you have stripped away the accruals and found the raw facts.
And once you have mastered that distinction, you are finally ready to actually build the architecture of a project. You are ready to construct the cash flow timeline.
Yes, the
Yeah.
timeline. This is the mechanical heart of literally any long-form exam question. A capital budgeting project is essentially a life cycle. It is born, it lives and works, and eventually it dies.
And we map this life cycle across a timeline broken down into 3 distinct, non-overlapping phases.
Let's name them. Phase 1 is the initial cash outlay at time 0. Phase 2 is the stream of annual net cash inflows during the project's working life. And Phase 3 is the terminal value in the final year.
Perfect. Let's thoroughly explore phase 1, time 0.
The moment of commitment.
This is the net investment required to get the project off the ground. And a very common mistake students make is assuming the initial outlay is simply the sticker price of the new machinery.
Oh, the sticker price is just the very beginning. The timeline requires every single cash movement necessary to get the asset fully operational.
Let's listen. You buy the machine. You have to pay freight charges to ship it across the country.
Yeah.
You have to pay import customs duties if it is coming from overseas.
Yep.
You have to pay a specialized engineering firm to install it and integrate it into your factory floor.
Every single one of those checks you write is part of the initial cash outflow. It all piles up at time 0.
Furthermore, you must account for the initial injection of working capital.
Right, because a new multi-million-dollar production line doesn't just run on air.
It requires a dedicated stockpile of raw materials to get started. It requires a buffer of cash in the bank to manage the new payroll. It might require extending credit to new vendors.
This sudden surge in required working capital is money that you must pull from the corporate treasury and lock inside the project. Therefore, an initial increase in working capital is a hard cash outflow at time 0.
That makes intuitive sense to most students.
Mm.
It is the cost of standing up the operation.
But the complexity completely skyrockets if this isn't a brand new expansion, but rather a replacement decision, right?
Oh yes, the tax labyrinth.
Because if you are replacing an aging industrial oven with a state-of-the-art thermal array, you have an old oven sitting in the middle of your factory taking up space. You have to get rid of it.
And getting rid of an old asset triggers what is arguably the most convoluted section of the corporate finance syllabus. Examiners intentionally use this to separate the exceptional students from the average ones.
Let's navigate this labyrinth carefully. To survive it, listener, you need to understand 2 distinct definitions of value.
First, there is book value. As we discussed, the accountants have been systematically depreciating this old asset over the years.
The original cost minus all that accumulated depreciation equals your current book value.
Exactly. It is a purely fictional number that exists only on the company's balance sheet.
Now, the second definition is cash salvage value. This is the brutal reality of the open market.
It is the amount of cold, hard cash a scrap dealer or a competitor is actually willing to hand you in exchange for your old asset today.
So the entire tax labyrinth is dictated by the collision between the fictional book value and the actual cash salvage value. There are 4 possible scenarios here, and you need to know exactly how to handle the cash flow implications of each. Let's go through them.
Scenario 1 is the anomaly. It is when the stars align perfectly and the cash salvage value is exactly equal to the book value.
You sell the asset for exactly what the accountants say it is worth.
In this rare case, there is no tax implication whatsoever. The transaction is perfectly clean. Your initial cash outlay for the new project is simply reduced by the cash inflow from selling the old asset.
Easy. But the real world is messy. Let's look at scenario 2, the normal gain. This happens when you sell the old asset for more than its book value, but less than what you originally paid for it years ago.
Let's frame this with a concrete corporate example. 10 years ago, your logistics company bought a heavy-duty transport crane for $500,000.
Okay, original cost, $500K.
Over the decade, you aggressively depreciated it. Today, your accountant says the book value is only $100,000. The asset is mostly written off.
Right.
However, you find a smaller logistics firm desperate for equipment, and they offer you $250,000 in cash for the aging crane.
Okay, so on paper, my asset is worth $100,000. But I just got handed a real check for $250,000. I have realized a gain of $150,000.
And whenever you realize a gain, the government immediately steps into the room.
The tax man cometh.
Always. The tax authority looks at that transaction and says, wait a minute, over the last 10 years, You use depreciation to lower your taxable income by $400,000.
You told us this machine was losing value rapidly.
But now you just sold it for a massive premium over its book value. You over-depreciated.
You claimed too much of a tax shield in the past, and we want our cut back.
Exactly. This is officially called depreciation recapture, or a normal gain. You owe taxes on that $150,000 difference. If the corporate tax rate is 40%, you owe the government $60,000.
Let me make sure I'm following the math. So, mapping this back to our time zero cash flow for the new project. Let's say the new robotic crane costs $1 million. My outflow is negative $1 million.
Right.
I sell the old crane, giving me a cash inflow of positive $250,000.
Correct.
But then I have to write a check to the tax authority for $60,000. So that is a negative $60,000 outflow.
Yep.
So the net investment at time zero is $1 million minus the $250,000 inflow plus the $60,000 tax penalty. It changes the fundamental math of the replacement.
It absolutely does. Now, let's look at scenario 3. This is rare, but examiners absolutely love it because it tests multi-layered logic. This is the capital gain scenario.
Okay, brace yourselves.
It occurs when you sell the old asset for more than its book value, A&D remarkably, for more than its original cost.
This sounds impossible for machinery, like things don't go up in value. But think about real estate, right? Or highly specialized equipment in a supply chain crisis.
Precisely. Let's say you bought a parcel of land and a warehouse for $3 million. You depreciated the warehouse structure down, so the total book value is now $2 million.
Okay.
But because the city expanded around your warehouse, the property value skyrocketed. A developer buys the entire old asset from you for $4 million in cash.
Wow. Okay, this triggers a dual tax event.
It does.
First, you have the normal gain, the depreciation recapture we just talked about. You bought it for 3, book value is 2. So you have a $1 million normal gain. That gets taxed at the standard corporate rate, let's say 40%. So that is a $400,000 tax outflow.
Good. That's part one. But you also sold it for $1 million more than the original $3 million purchase price.
Right. From 3 up to 4.
That extra $1 million is pure appreciation. It is a capital gain. Tax codes usually treat capital gains differently, often at a lower preferential rate to encourage investment. Let's say the capital gains rate is 20%.
So 20% of that $1 million capital gain is another $200,000 tax outflow.
Yes.
So the total tax bill, $400,000 normal tax plus $200,000 capital gains tax, $600,000 in cash, leaves the building at time zero.
The ability to separate the transaction into a normal gain tranche and a capital gain tranche and apply different tax rates to each is a hallmark of a high-scoring exam answer. It shows you deeply understand the mechanics of the tax code.
Okay, which brings us to the final and perhaps most psychologically fascinating scenario. Scenario 4, the loss. What happens when the cash salvage value is actually less than the fictional book value?
Let's say your accounting books say the old machinery is worth $300,000, but the technology is hopelessly obsolete.
Nobody wants it.
Nobody. You finally find a scrap metal dealer who will haul it away, but they only give you $50,000. You have taken a massive hit, a $250,000 loss on the sale.
Human intuition says a loss is inherently bad. But in the twisted logic of corporate finance, a loss on an old asset is actually a disguised blessing for your time zero cash flow.
Because it acts as a tax shield. When your corporation files its overall tax return at the end of the year, it aggregates all its profits and losses across every division. That $250,000 loss on the old machinery reduces your company's overall taxable income.
So by losing money on the machine, you are shielding your other highly profitable divisions from the tax man.
Yes.
If your corporate tax rate is 40%, a $250,000 loss shields $100,000 of cash from taxes. That is $100,000 that the government does not take from you.
Therefore, a tax saving is mathematically treated as a cash inflow at time zero.
Wait, a loss is an inflow?
Yes, a tax-saving inflow. Your calculation for the new project becomes the massive outflow to buy the new machine, a tiny inflow from the scrap dealer, and a substantial secondary inflow from the tax shield generated by the loss.
It is a brilliant systemic incentive. The government is essentially partially subsidizing the pain of upgrading obsolete equipment, encouraging companies to modernize.
Exactly.
Okay, that covers the absolute labyrinth of time zero. The concrete is poured. Now, the project wakes up and starts working. We enter phase 2 of the timeline, annual net cash inflows, or cash flow after tax, CFA.
This is the operational engine of the project. This is the cash generated year after year. And to calculate it accurately, you have to run a very specific sequence, carefully managing the presence of depreciation.
And notice, listener, we are not including interest payments on debt in this operational cash flow calculation. That is a very common mistake. You don't subtract the cost of the bank loan here.
No, you don't.
Why? Because the cost of financing the project is accounted for later, baked into the discount rate. If you subtract interest here and then use a discount rate later, you are double counting the cost of money.
Exactly. So we focus purely on operations. We start at the top line, annual sales revenue generated by the new project. From that, we subtract the actual out-of-pocket cash expenses, raw materials, labor, marketing.
That leaves us with earnings before depreciation and tax. Now, even though we just spent 20 minutes explaining why depreciation isn't real cash, we actually have to subtract it here.
We must subtract it because the tax authority demands it. We're trying to find our taxable income. So we subtract the annual depreciation expense. This gives us earnings before tax, or EBT.
Now we apply the corporate tax rate to the EBT. We calculate the tax bill and we subtract it. This leaves us with earnings after tax, ET, which is the equivalent of the flawed net income number.
And now, the final crucial step. We perform the CPR we discussed earlier. We took depreciation out purely to calculate the tax shield. But it isn't a cash outflow. So to find our true cash flow after tax, our CFAT, we must add the depreciation amount back to the earnings after tax.
Okay, let's repeat that sequence. Revenue minus cash expenses minus depreciation equals EBT. Minus tax equals EBT. Plus depreciation equals CFT.
That sequence is the heartbeat of the project timeline.
There is also an alternative approach, right? If the exam presents a replacement decision using differential data.
Yes. Instead of calculating the entire CFET of the new machine and comparing it to the entire CFET of the old machine, you only look at the changes.
Right, the delta. You look at the increase in sales revenue the new machine provides over the old one. You subtract the change in operating expenses. Maybe the new one is more energy efficient, so the expenses actually decrease.
You calculate the differential depreciation between the new and old asset, apply the tax rate to the differential profit, and add back the differential depreciation.
It is a massive shortcut that gets you to the exact same incremental cash flow number. If the exam gives you data framed as savings over current operations, use the differential method.
Absolutely.
All right, the project has run its course, the machinery is exhausted, the product cycle is over, we arrive at phase 3, the terminal value in the final year, the project is finally being decommissioned.
The final year is unique because it experiences a pileup of cash flows. First, you have the standard operational CFGA that the project generated in that final year, calculated just like we just discussed.
Standard operations, got it.
But then you have the liquidation events. You sell the project's machinery, you calculate the cash salvage value of the new equipment, and you must run it through the exact same tax labyrinth we did at time zero.
Right. Is it a gain? Is it a loss? Calculate the tax implication and record the net cash inflow from the salvage.
And finally, there's the unwinding of the working capital. Remember, at time zero, we locked up millions of dollars in extra inventory and cash buffers to start the project. That was a cash outflow.
Well, the project is dead. You don't need a massive stockpile of raw materials anymore. You sell off the remaining inventory. You collect the final accounts receivable. You empty the project's cash buffer back into the central corporate treasury.
This is known as the release of working capital. Because that trapped liquidity is finally returning to the wider company, it is recorded as a massive cash inflow in the terminal year.
Now, I have to play the skeptic here for a second.
Go for it.
If we inject $1 million of working capital at time zero as an outflow, and we get that exact same $1 million back as an inflow in year 10, aren't we just doing accounting gymnastics? The net effect is literally zero. Why do we obsess over tracking it on the timeline?
That question cuts to the absolute core of modern finance. And the answer is the time value of money. $1 million today is a fundamentally different creature than $1 million 10 years from now.
Because of inflation, sure, things get more expensive.
It is inflation, yes. But more importantly, it is opportunity cost. If you log $1 million inside a warehouse full of spare parts for a decade, that money is paralyzed.
Right.
If you hadn't locked it up, you could have invested in the stock market. You could have bought treasury bonds. You could have funded a different, highly profitable venture. By trapping the cash in working capital, you are suffering a silent compounding loss of potential returns every single year.
So getting the $1 million back 10 years later doesn't make you whole. The money has withered. it has lost its purchasing power and its potential.
Exactly. The timing of the cash moving in and out isn't just a detail. It is the entire ballgame.
And the recognition of that harsh truth is what separates the primitive methods of evaluating projects from the sophisticated ones.
It really is.
Which perfectly transitions us out of the timeline construction and into the actual decision-making metrics. We have our cash flows mapped out. How do we judge if they are good enough? Let's start with the older, simpler methods, the quick and dirty techniques. Academically, they are called non-discounting cash flow techniques.
They're called non-discounting because they commit the cardinal sin of finance. They completely ignore the time value of money.
Right.
They treat a dollar earned tomorrow as mathematically identical to a dollar earned 10 years from now. They assume there is no inflation and zero opportunity cost.
Despite this glaring, massive flaw, examiners test them because they are historically significant and honestly still used by smaller companies as a rough mental check. The most famous is the payback period.
Yes, the payback period is defined as the amount of time required by a firm to recover its initial investment from the project's cash inflows. It is an obsession with speed.
It asks a very simple, very terrified question. How fast do I get my money back?
It is the ultimate metric for risk aversion. If you invest $2 million, you're sitting there exposed, holding your breath, until the project generates $2 million in operational cash flow. The moment you hit that break-even point, you can exhale.
The math is incredibly straightforward if the project generates an annuity, meaning a constant, unchanging stream of cash every year. If you invest $2 million and the project generates a rock-solid $500,000 every single year, you simply divide the initial investment by the annual flow.
$2 million divided by 500,000, the payback period is exactly 4 years.
But the real business world doesn't operate in perfect annuities. Projects scale up slowly, hit a peak, and then tail off. The cash flows are lumpy and uneven. In a mixed stream scenario, you have to build a cumulative tally.
Let's walk through that. Imagine you invest $5 million in a massive software rollout. Year one, you were just beta testing, so you only bring in 500,000. Cumulative total, $500,000. Year two, adoption grows. You bring in 1.5 million. Cumulative total is now 2 million. Year three is the breakout year. You bring in 2.5 million. Cumulative total is 4.5 million.
So we are trying to reach 5 million. At the end of year 3, we are sitting at 4.5. We know it takes 3 full years plus some fraction of year 4.
To find the exact fraction, you look at what you still need. You need 5 million, you have 4.5, you need 500,000 more.
Then you look at the projected cash flow for year 4. Let's say year 4 is projected to be a monster year, bringing in $2 million total.
You take the amount you still need, 500,000, and divide it by the total expected in the next year, 2 million. 500,000 divided by 2 million is 0.25, a quarter of the year.
So the payback period is 3.25 years. The decision rule is management simply sets an arbitrary cutoff. They might declare, we operate in a volatile tech sector. We do not accept any project that takes longer than 3 years to pay back.
And because our project is 3.25 years, it gets rejected.
It is incredibly simple to calculate and easy to explain to a board of directors. But, as we mentioned, it has massive structural flaws.
Massive flaws.
Let me paint a scenario. Imagine you are the CEO of a pharmaceutical giant. You have 2 projects competing for capital. Project A is a minor tweak to an existing over-the-counter painkiller. It costs $10 million to launch, and it will generate $3.5 million a year for 3 years, then 0 after that. It pays back in under 3 years.
Okay, very fast recovery.
Now, Project B is a revolutionary cure for a rare disease. It requires a massive $10 million clinical trial. Because of regulatory hurdles, it generates absolutely 0 cash for the first 4 years. But in year 5, the patent clears, and it generates $50 million a year for the next decade.
Well, by the strict logic of the payback period, you reject the cure for the disease and fund the painkiller tweak.
Exactly. The payback method is totally blind to anything that happens after the break-even point. It actively punishes long-term, highly profitable innovation in favor of short-term, low-yield quick flips. It is a measure of liquidity panic, not a measure of wealth creation.
Examiners love that specific critique. If you are asked to evaluate the payback method, you must articulate that it ignores cash flows beyond the payback point and it ignores the time value of money.
There is one other non-discounting method you need to know, the accounting rate of return, or ARR. It is sometimes called the return on capital employed. And listener, put a giant warning sign next to this in your notes.
Yes, this is the anomaly.
Yeah.
The ARR is the only capital budgeting technique we discuss that uses accounting profit net income instead of cash flows.
It is essentially a vanity metric. It looks at the project purely through the lens of the income statement. The formula is the average annual profit after tax divided by the average investment.
To find the numerator, the average profit, you simply take the net income projected for each year of the project, add them all together, and divide by the number of years. It is a simple arithmetic mean.
And the denominator, the average investment, has a specific formula that you just have to memorize. It is the initial investment plus the terminal salvage value divided by 2.
The resulting ratio gives you a percentage. A project might have an ARR of 15%. Management sets a hurdle rate, say 12%, and accepts any project that clears it.
But why would anyone use this? We just spent 30 minutes explaining why accounting profit is a dangerous illusion for capital allocation. Why does this metric even exist?
Because of the agency problem. Corporate executives are often compensated based on the company's accounting earnings per share. They want projects that make their annual income statements look beautiful so they hit their bonus target.
Of course.
ARR speaks their language, even if it is fundamentally flawed from a cash perspective. It is a reality of corporate politics.
Right.
But fundamentally, like the payback period, it completely ignores the time value of money.
Which finally brings us to the promised land, the solutions to these flaws. Section 5, the exam heavyweights. The discounted cash flow techniques, or DCF. These are the models that actually rule Wall Street and modern corporate strategy.
The philosophy of DCF is simple but profound. A project is nothing more than a series of future cash flows. But those future cash flows are in a foreign currency.
A foreign currency?
The currency of year $5 or year $10. Because of inflation and opportunity costs, year $10 are worth significantly less than today's dollars.
DCF techniques provide the exchange rate. They use a discount rate to translate all those future uncertain dollars back into the hard currency of present value.
And the undisputed king of these methods is net present value, or NPV. If you understand NPV deeply, you understand the core of corporate finance.
The textbook definition of NPV is the difference between the present value of future cash inflows and the present value of the initial cash outlay, discounted at the firm's cost of capital.
Let's break down the architecture of an NPV calculation. You start with the timeline we built earlier. You have your massive outflow at time 0. You have your operational CF8 for years 1 through 10. You have your terminal salvage value and working capital release in year 10.
Step 2 is identifying the discount rate. This is often handed to you in an exam, but in the real world, it is the firm's opportunity cost of capital.
Think of it as the hurdle of financial gravity. If your company can reliably earn a 10% return just by investing its money in a diversified portfolio of stocks and bonds, then 10% is your baseline.
Right.
Any project you take on must yield more than 10% to justify the massive risk of locking the capital up in a physical factory. 10% becomes the discount rate.
Step 3 is the actual translation. You take the cash flow of each future year and you apply the discount factor to shrink it back to its present value. $1 million projected in year 7, discounted at 10%, shrinks down to roughly $513,000 in today's terms. You apply this mathematical shrinkage to every single future cash flow.
And the final step is the grand summation. You add up the present value of all those shrinking future inflows. Then, you subtract the massive, undiscounted outflow of the initial investment at time 0.
The result is a single dollar amount, the net present value. And the decision rule is beautifully absolute. If the NPV is greater than 0, you accept the project.
If the NPV is exactly 0, it means the project generated exactly enough cash to cover its costs and meet the required 10% return, but it didn't create any excess wealth.
But if the NPV is a positive number, say a positive NPV of $5 million, it means the project pays for the machines, it hits the 10% required return, and it drops an extra pure, newly created $5 million of wealth onto the company's balance sheet in today's terms.
The theoretical value of the company's stock should increase by exactly $5 million the moment you announce the project.
That is why it is the gold standard. It measures absolute wealth creation while fully respecting the time value of money. But it is not the only DCF tool. Sometimes executives don't want to look at an absolute dollar amount. They want to think in terms of percentages and yields.
That brings us to the internal rate of return, or IRR. If NPV asks, how much pure wealth does this project create at a 10% discount rate? The IRR asks a fundamentally different question.
What's the question?
IRR asks, what is the exact specific interest rate this project is internally generating?
Mathematically, the IRR is defined as the exact discount rate that forces the net present value of a project to equal exactly zero. It is the project's internal break-even yield.
Imagine a project is a black box. You shove $10 million in today, and the box spits out $2 million a year for 8 years. The IRR is the compound annual growth rate happening inside that black box.
Calculating it manually for uneven cash flows is an exercise in agonizing trial and error, isn't it?
Oh, it's terrible. You literally guess a discount rate, say 12%, and run a full NTV calculation. If the NPV comes out positive, it means the true yield of the project is higher than 12%.
So you guess again higher.
Right, you try 15%. If the NPV comes out negative, you overshot. You know the true IRR lives somewhere between 12 and 15. You interpolate until the NPV hits exactly zero.
Thankfully, Excel does this in a microsecond in the real world. The decision rule for IRR is to compare it to your cost of capital. If the bank charges you an 8% interest rate to borrow the money, and the project's internal machinery generates an IRR of 14%, you accept the project.
You are borrowing at 8 and yielding 14. You are capturing a 6% spread of pure value.
It is incredibly intuitive for executives to understand a percentage yield. However, examiners love to test the hidden flaw of the IRR. It contains a dangerous assumption.
A reinvestment assumption.
Yes. When a project generates that $2 million in year one, the IRR math implicitly assumes that the company takes that $2 million and immediately reinvests it into some other project that also earns that exact same high IRR of 14%.
Which is often a complete fantasy. If you have a once-in-a-lifetime blockbuster project yielding 40%, you probably don't have a dozen other 40% projects sitting around waiting for the spare cash.
Right. You might only be able to reinvest that interim cash at your standard corporate rate of 10%. Because IRR assumes you compound at the artificially high rate, it can aggressively overstate the true profitability of a spectacular project.
This is why, in a direct conflict between an NPV calculation and an IRR calculation, corporate finance theory dictates that NPV is always the supreme arbiter of truth. NPV makes the much more realistic assumption that interim cash is reinvested at the firm's baseline cost of capital.
Okay, we have NPV measuring absolute dollars and IRR measuring percentage yield. The third heavyweight is the profitability index, or PI. It is also known as the benefit cost ratio.
The profitability index is mathematically a close cousin of NPV. But instead of subtracting the initial outlay from the present value of the inflows, you divide them.
The formula is the present value of future cash inflows divided by the present value of cash outlays.
It creates a ratio. If the present value of all your future cash is $1.2 million and your initial outlay was $1 million, the PI is 1.2. The decision rule is to accept any project with a PI greater than 1.
Now, a perceptive student will realize something. If a project has a positive NPV, its profitability index will always be greater than 1. They always agree on whether a project is good or bad.
Always.
So why do we need both? If NPV is the supreme arbiter, why complicate the syllabus with PI? When would a CEO ever pull out a profitability index?
It becomes the most important metric in the room during a state of capital rationing.
Meaning the company is broke.
Or simply highly disciplined. Very few companies have unlimited access to capital. Suppose a company sets a hard budget. The entire corporation only has $100 million to invest in new projects this year. The CEO calls all the division heads into a room and they pitch their projects.
Okay, let's play this out. Division A pitches a massive mega factory. It requires the entire $100 million budget. They run the math, and the NPV is an impressive $10 million. It is a good wealth-creating project.
But Division B pitches a smaller software upgrade. It only requires $10 million to build, but it has an NPV of $3 million.
If the CEO only looks at NPV, she gives all the money to Division A because $10 million in wealth is greater than $3 million in wealth.
But that is a catastrophic misallocation of limited funds. Look at the efficiency. Division A spent $100 million to generate $10 million. They yielded a 10% wealth premium. Their profitability index is 1.1.
But Division B spent $10 million to generate $3 million. They yielded a 30% wealth premium. Their profitability index is 1.3.
Exactly. PI measures the bang for the buck. When you have a strictly limited budget, You don't want the single biggest absolute return. You want to rank projects by their profitability index, from highest efficiency to lowest, and fund a basket of highly efficient smaller projects until the budget runs dry.
So if the CEO funded 10 projects identical to Division B, she would spend her $100 million and generate $30 million in NPV, literally tripling the wealth creation of the mega factory. PI solves the puzzle of limited resources.
That is a phenomenal conceptual distinction. The final method the text covers is a hybrid attempt to bridge the old world and the new, the discounted payback period.
We established that the traditional payback period is flawed because it ignores the time value of money. The discounted payback method attempts to cure that specific flaw.
The mechanics are a blend. You still build a running cumulative tally to see how many years it takes to recover the initial investment, but instead of accumulating the raw projected cash flows, you calculate the present value of each year's cash flow first, and you accumulate those shrunken discounted numbers.
Because the discounted cash flows are mathematically smaller than the raw cash flows, it will naturally take longer for the cumulative total to reach the initial investment threshold.
A project that pays back in 3 years in raw numbers might take 4.5 years to pay back in discounted present value terms.
It is a more conservative, rigorous measure of how long your capital is truly at risk. However, it still suffers from the secondary flaw of the payback method. It completely ignores any massive, highly profitable cash flows that might occur in year 6, 7, or 8 after the break-even point is reached.
Right. It remains a metric obsessed with risk recovery rather than total wealth creation.
Wow. We have navigated the entire labyrinth. MBA listener, you now have the conceptual architecture to dominate this unit. Let's do a rapid, high-level synthesis to lock this into your memory before the exam.
Let's do it. Step 1, the philosophy. Capital budgeting is the high-stakes, irreversible allocation of massive funds for long-term strategic goals. It is the mechanism that translates abstract visions into measurable realities.
Step 2, the supreme trap. Never use accounting net income to evaluate a project. Net income is a smoothed-out fiction utilizing non-cash expenses like depreciation. You must perform CPR. You must add back depreciation and adjust for working capital to find the true liquid cash flow.
Step 3, the timeline. It has 3 acts. Time 0 is the net investment, including freight, working capital, and the complex tax labyrinth of normal gains, capital gains, and tax-shielding losses from selling old assets. Phase 2 is the annual cash flow after tax, driven by the operational delta. Phase 3 is the terminal year, where you salvage the machinery and recover the trapped working capital.
Step 4, the evaluation. Avoid the non-discounting illusions like the payback period and ARR. Anchor yourself to the discounted cash flow techniques. NPV is your ultimate measure of absolute wealth creation. IRR is your internal yield percentage, despite its reinvestment flaws. And the profitability index is your tactical weapon for ranking efficiency during capital rationing.
You now possess the analytical toolkit to walk into a boardroom, look at a multi-million-dollar proposal, and objectively determine if it will build an empire or bankrupt the company.
But before we officially sign off, I want to leave you with a philosophical thought that you won't find in the equations of your textbook. This raises a profound question.
Indeed. We have spent an hour constructing these mathematically rigorous fortresses. NPV, IRR, they feel so certain when you calculate them out to 3 decimal places on a spreadsheet. But you must never forget that the math is only operating on the inputs you provide.
And those inputs are just human guesses. You are forecasting consumer demand, tax policy, and global inflation a decade into the future.
What happens when your flawlessly calculated NPV, which greenlit a billion-dollar supply chain expansion, encounters a sudden, unprecedented global pandemic? What happens when a disruptive artificial intelligence renders the software you just spent 3 years building entirely obsolete overnight?
The numbers provide the illusion of control in a fundamentally chaotic universe.
The math, no matter how complex or elegant, is ultimately only as good and only as resilient as the fragile human assumptions underlying it.
A truly great financial mind doesn't just trust the output of the formula. They constantly stress test the assumptions feeding it. Best of luck on your corporate finance exam. You have the tools, you understand the traps, and you know the philosophy. Go crush it.